Yesterday, S&P Global, that's the company that gives us, among other things, the S&P 500 Index, released their annual report where they look at index funds and see how they performed versus actively managed funds. And we have the data for 2023 as well as data over longer periods of time. And we're going to look at that today. If you're new to the channel, my name is Rob Berger. We talk about investing in retirement, particularly for those in or near retirement. If that's of interest to you, I encourage you to subscribe to the channel. I also send out a newsletter every Sunday morning. It's free. You can sign up for that with the link below this video. And finally, I do a live Q&A show every other Monday at 7 p.m. Eastern Time. Would love for you to join there. People ask me questions, mostly about investing in retirement, but occasionally about current events and whatnot, and I do my best to answer them. So would love to have you join us if that's of interest to you. So here's what we're going to do. We're going to first look at this new report that just came out and see if, actively managed funds have finally outperformed index funds. Then we're going to actually look at some actively managed funds that kind of have a reputation for beating their respective benchmarks. And we're going to say, do they really? We're going to look at, for example, Fidelity Contrafund is one that is highly regarded. We're going to see how it does. And then finally, I'm going to show you an article written a couple of decades ago by Jack Bogle, the late founder of Vanguard. He's going to help us understand, we're going to talk just a little bit about why it is that really smart people managing money for an actively managed mutual fund have trouble beating their benchmarks. So that's what we're going to do. So we're going to dive right in. I'll leave links to everything I'm about to show you below the video. We're going to start with this article, literally just came out yesterday from S&P Global. This stands, by the way, is just for S&P, Standard & Poor's, and it's index versus actively managed. That's what the IVA stands for in this acronym. And so they give us just a summary of the report. As I said, I'll link to that, but let's dive right into the report. I want to show you just a couple of pages. This is a 46-page report with a lot of graphs. Again, I'll link to it, but I want to show you a couple of them. This is the first one. So this is for, you can see they highlighted in, I guess, a yellowish orange 2023, but this represents the percentage of large cap domestic, meaning United States, equity or stock mutual funds, and what percentage underperformed the S&P 500. So last year, 2023, 60% underperformed, which, you might think, well, actually that means 40% outperformed. That's actually not bad. And you can see that in past years, like 09, 48% underperformed, which meant 52% outperformed that year. And for 2007, that was the best year, at least in the last 20 or so, for actively managed funds. But of course, we're only looking at 1 year's worth of performance. And as we know, as long-term investors, we really should be thinking in terms of decades, not years. But fortunately, S&P Global gives us that data. And we can I'm just going to jump down to page 10 here. Here we go. So on an absolute return basis, this is the performance of, again, U.S. equity funds, and they have a number of different fund categories. Just sort of a total U.S. market. Here's large cap, mid cap, small cap. They have, as you can see, growth and value. And you can see, what percentage underperformed on a 1, 3, 5, all the way up to 20-year basis. To me, this is the most important because I'm thinking in terms of multiple decades as an investor. And that's true even when you retire. If you're 65 and you're planning, let's just assume you're planning for a 30-year retirement, that's 3 decades, right? So that's a long time. And you can see the vast majority, we can go right down the list, 94% underperformed, 93, just under 93, almost 96. We just go right down the list, all in the 90s. Actively managed funds underperformed their respective benchmarks. Now, we can also look, if we go, let me jump ahead, I think it's page 21. Nope, maybe it's page 20 or 22. Here we go. International funds, how'd they do? Well, global funds, we've got global, which would include the U.S. International, then they have small cap, and then emerging markets. We've got 20 years. The only one that stands out is international small cap, but even there, 78% of the funds underperformed their respective the benchmarks for international funds. And we can skip down to page 25, and we get fixed income. And you can see they've got government bonds, intermediate, short-term, investment grade, high yield. and it only goes out 15 years, but we look at the percentages that have underperformed. There's an interesting takeaway here. Some of these, like 59% underperformed, this is investment grade intermediate term bond funds, but that means 40% outperformed. And so I think there's this general sense among some that, maybe in fixed income, there's a better case for active management. And I suppose if we look at these numbers, depending on the specific sort of subcategory, maybe there is a stronger case. But as you can see, you still got to figure out how in the world you're going to happen to pick the funds that 15 or 20 years from now will be those 30 or 40% that in fact outperformed, and will you be able to stick with that fund over that time period? So there's some real practical considerations, but nevertheless, fixed income seems to, in some subcategories, to do a little bit better, but still the majority underperform in the long term. What's interesting is if you look at 1 year, many underperform as well, but there are some, again, this one, 70% outperformed, 70% outperformed, 80% for New York municipal debt funds, if that's of interest to you, outperformed. And here's the thing, and this is true for equity funds as well. This is where all the news stories come out. When you're going to read something online about what's going on in the world in terms of investing, the thing they're going to highlight is what's happening right now, this year, this month, today. And at any given time, there are going to be all kinds of actively managed funds that are outperforming. What they're not going to typically cover is what happened over the last 15 or 20 years. And that's really what matters to long-term investors, not what's happening today or even this year. Now, it does raise an interesting question. It's, well, okay, most underperform, but can we find those gems? Maybe there are those mutual funds or ETFs that are actively managed that year after year after year outperform. They may be the exception, but who cares if we can find those funds? Man, I'm all in, right? Well, a couple of things to think about here. The first is S&P Global actually thought of that, and they put together what they call a persistence scorecard that tries to answer that very question. Are there funds that consistently beat the benchmarks? Now, the data here doesn't go back as far. I'll show you their most recent report. It's right here. Now, this was released about a year ago, not quite, so I'm expecting their new report to come out if it's the same time period around May. But this is their persistence scorecard for the year end of 2022. I'll link to this. Here's the actual scorecard. And I want to point out two things. The first is this first bullet. They say, hey, only 5% of those funds that were above average for large cap equity funds in 2020 remained above average for the next 2 years. Only 5%. And in terms of the top quarter, those top quarter funds in 2020, none of them, 0%, 0.00%, if we want to be precise, continued in the top quarter for the next 2 years. It's very, very difficult for fund to stay at the top of the heap, even in the top quartile. And I think of ARK, that did 150% return. I think that was 2020. It was number one, and then the next year it was last. It's, these sort of funds that go to extremes one way or another, they can't stay consistent. And this report card kind of gives you a sense of that. Again, I'll link to it. I want to show you one other thing in terms of comparing actively managed funds to index funds. But before we do, just want to show you this page. This page. And again, I'll link to it. This is sort of a summary of all of their findings. And you can look at 10 years, 5 years. What they do is, I'll actually start at 1 year. They say, okay, over the last year, about 40%, this happens to be large cap U.S., 40% outperformed. If you go to 3 years, it starts to go down, only 20%. Go to 5 years, actually goes up a tad. 10 years, though, down to 12%. And at 15 years, almost 12% exactly outperformed. The vast majority underperformed. And you can view more categories here. We're looking at the different equity categories, right? You can see those here. And then you can also check out fixed income. So that's a way to kind of get a summary of everything I showed you. Now, maybe you've got a fund and you think, Rob, I hear you, I appreciate it, but I've got the fund that will outperform. It's outperformed, it will continue to outperform. Well, we're going to look at a couple of those. And we're going to start with, we're going to go to Morningstar. And the fund I want to look at is Fidelity Contrafund. See if we can look it up. Here it is. It's a well-known fund, and it's done extremely well. No question about it. According to Morningstar, it's a 4-star, but you can pretty much ignore that because those stars are not very useful. But 39 basis point expense ratio for an actively managed fund. That's very low. Obviously not as low as an index fund, but very low. Now, how would we think about comparing this to a benchmark, an index? Well, we could go to performance. And what we get here is a chart, and you can see in red over here, the red line stands for the index. The blue line is the investment. If we come up here, they're basically neck and neck. So the index actually was outperforming for quite some time. It looks like Contra has caught up, but it's basically neck and neck. And these returns would factor in the expense ratio. So this is net of expenses. But the thing that I would point out here is that you have to ask, what index are we actually comparing it to? And if you come down here, you can see Morningstar has created their own. A Morningstar U.S. LM Broad Growth Index, whatever that is. I'm not saying that's necessarily a bad way to compare it, but I have a better way, in my view, and that is to use Portfolio Visualizer. And you can see I've set it up. I've got the Contrafund. I've actually also thrown in an American Funds Growth Fund, which is a well-regarded, actively managed fund as well. And I'm comparing it to the Vanguard Growth ETF, which is an index fund that follows a large cap growth index. Why BUG? Well, if we go back, and this is really important, if you're going to compare a fund on your own, you want to make sure you're comparing apples to apples. If we go to the portfolio of the Contrafund, what do we see? It's a super large cap, super growth fund. And so I wouldn't compare this to the S&P 500, which would be a large cap, but it would be a blend here in the middle. And if we look at AGTHX, we can see the same thing, or something similar. Here it is. And by the way, this fund has an expense ratio of 63 basis points. That is factored into the returns, but it also, if we go to price, you can see it has a front load of 5.75%. That means for every dollar you put in, $5.75 goes to fees. That is not factored into returns. Keep that in mind. But if we look at the portfolio, let's see where it stands. Yeah, it's also high growth. So if we go back to Portfolio Visualizer, I want to compare them to a similar index fund, in this case, large growth. So if we run the analysis, the first thing we'll note is that it goes back to 2005. That's a good period, it's 20 years, but the data was limited on the Vanguard fund. And if we look at these, what do we see as results? Well, look at this. Fidelity Contrafund ended up at 88,000, clobbered American Funds. American Funds is out at 66,000. VUG was holding its own at 81,000, but goodness, Contrafund won out, and it had a slightly lower standard deviation, which meant it had slightly less volatility. Seems like a winner, right? Well, here's where, when you're comparing any two investments, you want to not just look at the end results, even though this is a fairly long period of time, 20 years, but you want to say, okay, does the starting period or the stopping period, does that affect the results in any way? Or is there maybe 1 or 2 or 3 years that are real outliers that if you remove those, the results change dramatically? Or on the other hand, maybe not. Maybe in this case, Fidelity's Contrafund just consistently, year after year, outperforms. We want to know that. It matters, right? So with Portfolio Visualizer, we can go down here to the annual returns. And we'll see here, okay, Fidelity Contrafund is blue. Vanguard Growth is orange. That's the one we're particularly interested in because those are the two that were sort of somewhat competitive. And you'll notice most of the time, they're reasonably close. Like here, Vanguard's fund outperformed Fidelity, but here Fidelity outperformed. It was a loss that year, and Fidelity outperformed here, but Vanguard outperformed here. But they're all relatively close. You'll notice though, and let me actually, to see it even better, I'm going to pull American Funds out. And that way we're only looking at 2 funds. We'll go back down and we can see the differences a little more dramatically. You'll notice this was a big year where Fidelity significantly outperformed Vanguard, and it was at the start of the period we're looking at. So it's going to have an effect going forward throughout this time period. And so when I see that, I think to myself, okay, it outperformed, but what if we just changed it from 05 to 2006? We just lose that first year. What happens? Well, now we're looking at 2006, and Vanguard actually outperformed. Now, it did so with more volatility, about 1.4% worth on standard deviation. But the point is, removing that 1 year, 2005, now, since 2006, Vanguard has outperformed. And by the way, if we started at 2008, you would see an even bigger difference. The point being that Vanguard has really outperformed Fidelity pretty significantly. You can see it. We go down here. Yeah, now we're at 63,000 versus 56, or 12% versus 11.3. At the end of the day, Fidelity's Contrafund has had a great run. It's a good fund, but at least in recent times, meaning the last 15 years or so, it actually hasn't outperformed, in this case, an index fund tracking similar types of investments. The real point, though, is when you're going to compare two funds, first of all, make sure you're comparing apples to apples. If it's a large cap growth, you want to compare it to a fund, an index fund that tracks large cap growth. And then you want to look to see if there are any outlying years, particularly at the beginning of the time frame you're looking at, to see if maybe that's influenced the results in a way that are important to you. Okay, now the last thing I want to show you is an article from Jack Bogle, and it really goes to the question of why do actively managed funds have trouble over the long term beating an index fund? And we can assume that the actively managed funds are run by really smart, hardworking people. Of that, I have no doubt. But there are really two things going on here. The first, of course, is expenses. Actively managed funds are more expensive. So just to keep even with an index fund, they've got to outperform by whatever their expenses are. And this gets me to Jack Bogle's article. Let me show it to you here. This was, I think, 1991, maybe this was written. Let me see if I can find the date. No, well, it's published 2000, maybe it was 2014. Oh, yeah, it references this 91 article. But in any event, it's the arithmetic of all-in investment expenses. Mr. Bogle published this. It's an excellent article. The thing I wanted to point out to you, and there's some history that he goes through. When we think about expenses, we often think about the expense ratio, which of course is an important part of that equation. And then for things like American funds, there can be sales charges, which is an important part of the equation. But what Mr. Bogle points out is those aren't the only things that matter. He talks about transaction costs. Actively managed funds tend to buy and sell a lot more than index funds. So, and that those transaction costs are not reflected in the expense ratio. They're over and above the expense ratio. That's the first thing. A cash drag. Actively managed funds tend to hold more cash than index funds. We can actually look at this. Sometimes it's not a lot more, but I don't know about this fund. Okay, here we go. This is just an example. American funds, cash 4%. It's a lot of cash. Now, if we compare that to VUG, of course, I haven't looked at this ahead of time, so for all I know, this fund has 12% in cash. Well, I guess we'll take a look. I doubt it, though. Yeah, just 0.22. So index funds tend to have a lot less in cash, and holding more cash is long-term, great when the market's falling, right? But long-term is a drag on performance. So that's the first thing. And going back to the article, so we've got transaction costs, we've got cash drag. We mentioned sales loads charges, like for American funds, some American funds. And then he also mentions down here taxes on taxable investors, because the turnover of these funds tends to be a lot higher than index funds, meaning they're buying and selling more. If you're in a taxable account, could trigger a lot more taxes. And in fact, just quickly, I'll show you for, I haven't looked at this ahead of time, but if we go to the American funds, I'll show you where you can see some of this. So here is the portfolio, and you can see the turnover rate. I think it's right down here. Here we go. Portfolio turnover is 31%. That's not outrageous, but it's going to be significantly higher than VUG, and I'll show you that in a minute. But before we do that, the other thing you can do is come down to performance, look at distributions, and it will show you like they're distributing a lot of capital gains. That's the blue part of the boxes here, the charts. So if this is in a taxable account, you could be really paying a lot of taxes. If we go back to VUG, by the way, remember that 31% turnover? If we go to portfolio, we should see, again, I haven't looked at this ahead of time, so maybe, but we should see much smaller turnover. Yeah, just 5%. So keep that in mind. By the way, fixed income, just by its nature, has a lot of turnover, even for index funds, but we were looking at equity funds. Now, the last thing to keep in mind as to why actively managed funds don't beat indexes over the long term is this. I really believe a lot of money managers, good money managers, if you gave them $1 million, could outperform a benchmark for maybe a very long time. They're very talented, and with $1 million, a lot of money to you and me, but it's just a rounding error for some of these mutual funds. They could invest in small companies that would really move the needle. But if we go back to, I'll show you this, we go back to the American funds just as an example, and I have no idea how much, what its assets under management will be, but I'm sure it's quite large and well above $1 million. Let's see if we can find it here. Yeah. It holds almost 270 billion, that's with a B, the dollars in assets. And when you've got that kind of money, you really need to make big bets on big companies. You can't invest in some tiny company. It's just not going to move the needle much. It's a point that Warren Buffett has made with Berkshire. He says, look, I'm dealing with hundreds of billions of dollars in capital. Don't expect me, and this is the great Warren Buffett, to be able to have the same kinds of returns I did decades ago when Berkshire was a lot smaller. So for these large mutual funds, it can be very difficult just because of the amount of money they're managing to beat the benchmarks. So there you go. I know I've thrown a lot at you. As I said, you'll find links to all of this below the video. But at the end of the day, it's just the fact that index funds outperform actively managed funds, particularly when you factor in, as Jack Bogle's article points out, all of the expenses that you're going to have to deal with active management, which go well beyond just the expense ratio. They just underperform. And there you go. If you have any questions, leave them in the comments below. Be happy to help you out any way I can. And until next time, remember, the best thing money can buy, apart from an index fund, is financial freedom.